Hi, folks, and welcome to Mackey's Retail Roundup, where today's theme is good luck betting against America, suckers. Yeah, I realize things are kind of politically fraught, but check it out. We've got a summer Santa Claus breakout rally looming in retailers. I don't fully understand it for reasons that we'll get to, but we talked about the breakout for the last few weeks, and it had every reason in the world to pause, every reason really that you can possibly think of. I mean, open a newspaper, all kinds of good explanations for why things are going to get worse, and yet they don't and continue not to. We got through earnings week. Okay, the XRT, which is your best index of what's going on with the consumer overall, that is actually kind of getting up to February 1st highs. February 1st might seem like kind of an arbitrary date. It's not. In one of the president's first kind of major moves on his website, you can go see it today. That's where I got this. This was the opening shot, February 1st, of the trading war, which continues kind of quietly, unabated. They're all hanging out and talking a lot. Things are weird. We don't have to get into it, but that's where the retail stocks were. It's not a coincidence that they topped. That was give or take right about here. And so that's been a pretty significant amount of resistance, or at least that was the abandoned hope. All ye who buy stocks for at least a little while fell quite a bit from 80 to 60. That's a 25. That's a bear market in anyone's book. Didn't last long, though. April 7th, happy birthday to me. Happy birthday to the brand new spanking embodiment of bullishness, the bull market we're in right now, which we're cranking up. We're getting back to near 80 again, those February 1st highs. And I get it. I understand why you would be skeptical. I've been skeptical. I am skeptical, but I haven't been bearish. And I'm not getting more bearish now, even though we're getting back to those levels, which in theory would be resistance, because the problem here with the basic idea is that you're going to have to pay more for the stocks. They've gotten more expensive since you raised the tariffs. These numbers, 25% China, 10% Canada, 10% Mexico. China, of course, became a gazillion percent, an embargo percent, which put everybody out of business. But these are the new baseline. So, the retailers and the consumer seems to be strapped, and we're all going to go in recessions. And yet Disney just broke out to a 52-week high right now, today, because they bought Hulu, home of Shoresy. I don't know if you guys seen it, but holy crap. If you want a good sitcom about hockey, Junior League Canadian hockey, Shoresy is your program. That and The Bear are pretty much all that Hulu does. Good enough. Iger is on a roll. He's on a rampage. He gets paid the big dollars for a reason, because Bob Iger, CEO of Disney, kicks a dump truck full of ass, and Disney is just grabbing the bag. Iger's retiring at the end of this year. He does not want to go out a loser. In fact, he will not. He'll run the place until he's 180 years old. Probably, actually, no matter what happens, but especially if the stock doesn't make new highs. So they're just grabbing the bag. It's true to the times. If they can make money on it, they're doing it. Disney is doing college sports, high school sports, and gambling all at the same time. Nothing can possibly go wrong. There's no way society will regret that. Maybe we should sell painkillers on those same advertisements. Doesn't matter. No one cares. They took a Middle East grab bag from Qatar, a country that killed people to build World Cup stadiums a few years ago, but screw that. They make a nice fake Louvre, and Disney took a franchise fee for parks there. That reinvigorated the park, but there just aren't that many Disney parks. There's only like 10 of them or something in the entire world. So they're going to make a ton of money, particularly because it's a franchise deal. Anyway, that stock's working. That's a classic winner. That makes sense. But look at this. Target a little Minnesota company that I realize I talk about way too much, so we'll just touch past them. That stock's breaking out today. It's reached the vaunted Century Club for the first time in a long time, or not that long. The stock goes down pretty fast, to be honest. But this is in the wake of an earnings kind of debacle, fiasco, whatever. Point is that you need fundamentals, technicals, and a thesis to move a stock. Target has not really fundamentals, but it's got a good enough thesis to replace management. It goes much higher. A month ago, that whole theme would have just gotten you slapped in the face and people would have sold their shares. Right now, that kind of idea is working. So you got mediocre, kind of cheap, bad companies working just with the idea that they're only trading 10 times earnings. People are willing to buy into it. That's bullish. Terrible companies are getting a bid. Macy's, Kohl's, Under Armour. If terrible seems harsh, here's a 3-year chart. I ran this in advance because I realized I can be harsh when I'm talking nasty about companies like Macy's. That's PTSD. My first job was selling shoes at a Macy's. I put shoes on men's feet. Enough said. Not that fond of the companies, but I tell you what, this is the last 5 days. 9% for Macy's. Kohl's up 14%. Kohl's still has liquidity issues. I promise they do. No one really seems to care. They might be able to sell some bonds. They might not. They have to refinance. They're probably not going to die, though, this summer. And that was the worst case scenario being priced in. I briefly thought that they were going to be screwed. Now I'm just getting out of the way of these things because they're not very good companies. Remember the 3-year charts? Doesn't matter. They're getting huge bids right now, going higher in some cases into earnings. So can't bet against those. It's down to even Lulu, which we warned you about last week, which proved to be rather prescient because Lulu kind of crapped the bed a little bit with their latest earnings statement, which was about the 5th time in a row they've done it, and that's going to beat up a stock. But even here, now you're getting to the point where Lulu's trading at levels. Last time it was here, they earned about $5 a share on $4 billion rev. This year, they'll earn about $14, maybe $12. Give or take. That's actually last year. They're in 1467. This year they're earning somewhere around there. 10.6 billion in revenue, probably be about 11 billion this year. It's a much bigger company, is my point. And I realize you pay less for growth companies, or you pay more for growth companies than you do when they stop growing. But it's really just hard to be short. Add it all up, and you're kind of running out of things to be bearish on, and you can't find a reason to be bearish. Stocks tend to drift higher. If cheap's getting bought, that's a sign of faith. It's a sign of the economy. We continue to find a big boost in buying those stocks of companies that just aren't going bankrupt. That's good enough. Is that normally good enough? Not really, but there we are. We got companies that are reporting this week. Dave & Buster's is one of them. I didn't highlight them for one of the names of the week, but we'll get to them. That stock's much higher. Nothing is really going right there, but they're not dying. And we need a few more weeks, basically, until we get to the point where the 90-day delay becomes a ticking time bomb. Because, again, we can't do business with China at the tariff rates there were before. So at this point, that anything close to that, anything close to a non-deal with China would be met probably fairly grimly by the market, I would expect. But that's going to be a few weeks from now. The field position is good, in other words, and you can kind of just be at least cautiously optimistic, or you need a catalyst to the downside. Because right now, any stories getting bought, the idea that once Skechers, the shoe company, and then Foot Locker got purchased, you kind of had people sniffing around. And as a result, you're just seeing a pretty good bid in companies like Macy's and Kohl's, which rejected buyout offers for multiples of what they're selling today just a couple of years ago. Earnings ahead. Play the earnings ahead music. We've got GameStop. Speaking of garbage companies, we're getting to the bleak part of the mall. Back in the 80s, when I was just a flowing hair youngster, we would bike to the mall, and there was the nice part of the mall where mom would shop and where the Dayton's people go. And then there was the basement where you had Piccadilly Circus, and you had the place that they used to do the iron-on T-shirts, and maybe a Spencer's gift shop if you were feeling kind of naughty and none of the parents were around and they weren't because it was the 80s and the parents were never around. But that's the kind of place that you would find the GameStop. That's where you find them in the mall. It's the lowest rent portion of the mall. No one wants to go there. Chewy. I've talked about this company a lot because it's a huge winner and I love it. And who doesn't love good dogs? They report this week. Lovesac, which is a real company, that's a real name. I'm not just saying that to be rude. They report that's a super high end. They're the guys that if you buy a sectional and you put speakers on the inside of it, just because that's where you put expensive speakers and underneath your bottom on your mattress and your sectional. Lovesac's your company. They have beanbags starting at about $1,800, give or take. So this is good to have, and they make them all in China. They've got some headwinds, is what I'm saying, folks. That stock, though, has kind of fought it off for a while, and we're going to get into it more. RH on Thursday, and we got Stitch Fix and Dave and Buster's, the aforementioned Dave and Buster's, where you can just watch the game, get a little hammered, let your kids play video games, and hang out at the mall. It's, again, a bleak part of the earnings period, but there's huge moves. Speaking of which, RH, the former Restoration Hardware, they report Thursday 18% implied move in this stock. If you remember on April 2nd, Liberation Day, the RH, that was the last time they reported. Apparently, it's the CEO, Gary Friedman, who gives epic conference calls in any event. He was watching Liberation Day news, watching the presser, and then had to go and make his conference call. Now, he didn't see the stock reaction to the tariffs. The tariffs, RH produces all of their product. Essentially, it's every piece of super duper ridiculously, incredibly expensive furniture for what it is that they make. It's good stuff, but it's made in China. So the tariffs just shut down Gary's business. Stock fell 40-something% because it was also coupled with this massive warning. It's not a great company in the first place. They are super levered. They're exposed to China, housing, luxury, consumer, real estate. They're in the middle of developing in both Aspen, Colorado and Paris, just because I guess they couldn't find a way to actually make a permanent bonfire, an eternal flame of $100 bills. So instead, they decided to do that little dual effort, and balance sheet problems because they're a furniture store and it's really hard to finance all that stuff. Doesn't matter. Gary loves it. His comment on Pawn, it's watching the stock and he's kind of saying, I would bet with his forecast that the market's reacting negatively. At that point, his stock had fallen an additional kind of 30%. It was down almost 50% at the time. He looked at the quote and said, "Oh shit." Right there on the live conference call. It was incredible. And then he talked for another hour and a half about the state of the American consumer and just pretty much that we were doomed. Oh, shit. And the luxury furniture reactor. Anyway, they report this week. We get to see exactly how much they've improved. They're up still about 50% from the absolute bottoms that they hit in the wake of oh, shit. It was a huge rally. It was a much bigger rally before. People are skeptical for a reason. I'm skeptical, but if you want to listen to the call, it's just inebriate yourself how you will. Starvation, it's dehydration or something more chemical, and just kind of get ready to buckle up because Gary gives a lot of conference call information. A lot of chatting. Stitch Fix reports they're expected to lose money. They've got China exposure, but another one that could have a little window here. The stock has reacted pretty well from the lows. It's making its way back. It was priced as though they like Peloton before it, priced as though the business was just going to cease to exist. That didn't happen. And we're trying to figure out, if these companies are really going to make it. And if they are they cheap? Which brings us to the aforementioned Lovesac. Again, you walk past them in the mall, you're not really sure what they're doing, but it's a furniture chain. Very expensive furniture chain for folks that just bought new houses or are currently remodeling. If you're one of those people, mention it in the comment section because you're a unicorn, my friend. Congratulations on your success in a world that has gone mad. But no one's really buying that much furniture, and they're certainly not buying the Lovesac product. Huge volatility priced into this one. I bring it up because, man, the expectations are really low. The moves have been enormous in this. And again, there's a lot of reasons to think that Lovesack's going to report an El Stinko quarter. That happens Thursday. It's going to be an exciting week. Hey, I'll be here to kind of help you get through it, to guide us through it, and see if we can make some money to enjoy the rest of our summer and watch the U.S. Open in peace. Damn it. For all of us here at Stock Market Television, I thank you for watching. I'm Macke. This is the Retail Roundup. Godspeed and good luck.